So I'm like refunding. So what? I don't care. Everybody's in a lather. It comes out, and to me it was sort of, I really don't care. Janet Yellen said, we're going to do short paper. Yeah, we're going to do long paper, but we're the United States. Our listeners, our viewers who are not sophisticated, do they need to fear the fiscal system of America?
No, you shouldn't fear the fiscal system because the U.S. economy is still going to be very robust. There will be buyers for Treasury paper. It's just a matter of at what level will they step in. And we've had a relative lack of buying recently, but that's meant that yields have had to adjust. And as they've adjusted, that should incentivize more investors to think about owning bonds. And we do think that rates are going to keep rising, or they're going to stay elevated really until you see one of two things. Number one, until you see the macro data slow. We don't think that you've really seen that yet. Or two, until you see de-risking, until you see investors who think, you know what, rates are kind of high. Real yields, almost at 2.5% at the 10-year point. That's a decent own, and maybe I should think about de-risking in my portfolio.
This is such a valuable conversation, and I got to get to what we see on balance sheets right now, mark to market, and the rest of it in bonds. But let's stay on this theme right now of our new higher yield regime. How far out are you in the longer? I mean, if take any given yield, any given spread, is there a Cabana 1 year? Is it a Cabana 3 years? Well, how do you see the regime of longer?
Well, we just think that rates are going to have to stay higher for longer, not to reiterate the Fed mantra, but we really believe it because we've seen an economy that's been so resilient in the face of relatively elevated interest rates. And as long as that happens, that just is going to mean that the Fed doesn't have to cut for a while. Now, when I think about longer, I personally think about 5 years plus.
Oh, wow. Okay. You got my attention.
Just because, most investors who really focus on liquidity and liquidity management, they think generally 2 years, 3 years. But when I think about intermediate to long end, I think about 5 years plus.
Okay, and I'm going to invent this phrase right now. I haven't seen it anywhere else. I want copyright on this if you use it. Is it normal for longer? Is that really what we're talking about? Is we're back to a normal rate regime?
Well, it's certainly we're back to a regime that looks a lot more similar to the pre-financial crisis than the post-financial crisis.
And you got a 5-year window on that. So what maturity do you buy? I'm in cash. I'm really comfortable. At Bank of America, what maturity do you buy given a 5-year normal for longer view?
Well, it really depends upon what your overall investment horizon is and where your preferences are. We think that if you're focused at the front end, you probably want to be neutral to slightly overweight your benchmark. And if you're a more long-term investor, we think that you at best want to be neutral right now. And you want to stay neutral until you see those signs of feedback that tell you that higher interest rates are finally slowing the economy. Not just one data point here or there, but in the tier 1 stuff, in labor, more clearly in inflation. You want to stay neutral until you see those signs or until you believe that there's a clearer and more definitive negative feedback from risk assets, which I don't think that we have really seen sufficiently yet.